All right, the final one I want to talk about here is one Chi Wang Chong offered. This one is so good that I'm gonna demand that as an intern or a apprentice that he does this. This is a really good chart. So, as you know, the slope of the RL30 expressed as a z-score is my personal favorite for understanding market condition within context, right? So here's the all-important zero line. And now what he's computed is the z-score of the RL30 slope, all right? So to review, we got 30 bars of price. And then the straight line regression, the 30-period regression line, is the straight line that is the best descriptor of that price action. All right. Now, if we said that was a zero slope, perfectly flat, then this angle A, the bigger, if this was case one, we'd rather have something that was like this. All of the things being equal, I'd rather own 2 than 1. Because why? Because it's going up faster and farther, and the angle B is bigger than angle A. So we want better slope is better. Higher slope is better. Better is better. It's technical. So what's the z-score mean? Because this is just from one moment in time. We're looking at it today, and we're looking back 30 days to come up with the slope of that line. Well, let's take XLK. So what we're going to do is we're going to look back 180 days. And for each of those 180 days, so a day like minus 180, we take the 30-day regression line slope, we measure that, and then we score that number, and then 179. So for each of the last 180 days, we compute the slope value of angle A. And then what we do is we sort that, and then we find the maximum, the minimum, the average, and then the standard deviation of that, +1 and -1. And then we take today's slope and we see where it fits inside that stack of 180 data points, right? If this is the average and it comes out to be 1 standard deviation better than average, it gets a z-score of 1. If it's 1 standard deviation below that 180-day average, it gets a z-score of -1. So when we think of this as a z-score ladder, 2, -1, -2, you can take a look at today's price and say, oh, that is on a relative basis how good today's price is. Well, when you put a time series of those together, you get a second derivative of slope, and you're looking at the ebb and flow of its 30-period market condition, if you will. Now, what's really important is noticing the turning points at z plus and -2. All right, between 0 and 1, 1/3 of the data can be found, and between 1 and 2, or between higher than 1 and all the way to the max, about 1/6 of the data. And between 1 and -1, about 1/3 of the data. And between 1 and the rest is about 1/6. So this bulk of the time these guys spend between plus or -1. So this is like the giant rubber bands. When they start stretching, they can only go so far till you start getting the turning points. Now I want you to notice when you put technology versus materials versus energy versus finance, there's something really important and useful. This is evidence of sector cycling. Like at this moment, both materials, XLB, and tech had reached a Z-2 minimum, a low, and then started to get better. Money started buying them when they were on sale. Hey, we can buy technology and steel companies on sale. Let's do that. Instead of paying a premium for energy, we could be buying materials and technology when they're in a downtrend and starting to reverse. And instead of paying top, so let's sell our energy and buy tech and materials when it's cheap. Well, when that happens, you see energy roll over, and then you see materials, tech, and in this case, finance, all starting to rise while oil prices are tumbling. So what you're seeing is the routine sector cycling expressed. You're looking at the underlying trends of the currents, if you will. So here's when energy was rising, materials and finance were falling. And then tech started to fall. So those Z2 moments are really useful. Now what I want you to see, so finance has had a really good run. Materials, this is so good. This is how good materials and the steel companies are, is there's almost a Kata 2 formation in there. So the steel companies have really been benefiting from that. Now notice that tech, on the other hand, has almost like a Kata 2, but to the downside. It peaked. There was a little pressure, and it is starting to fail again. So is this going to come all the way down to Z-2? Stand by. What if this holds here? That would be good, because then it'll become the leader again. So we're at a real crossroads right now as we look at, there are three things that are rising. Finance and energy are really looking good, but you can already see materials starting to roll over. And you can see tech diminishing. So all other things being equal, if I saw another strong day in finance and energy tomorrow, like in Devon Energy. So if I'm playing XLE, I can look at Devon, Chevron. If I'm looking at finance, I can just look at FAS, triple finance, or I might look at JP Morgan, Goldman Sachs, etc. So I'm going to ask Chi Wing Chung to keep us updated with this on every weekend so that we can get a feel for those four sectors, because of the 10 sector spiders, these four seem to be the strongest independent trenders. Tech is often the engine that's driving the market forward in great leaps, but materials, energy, and finance work according to their own drummer, and they can be out of phase with the S&P altogether. The one thing I'm going to ask him to do is add SPY to this so we have a baseline. So I wanted to say that. Really good work. I've added a flashcard in Campfire for us. There's just a quick summary of the indicators and how we set them up. There is a summary of the main patterns of the foundations. there are these two supporting flashcards that describe those three patterns, the SSC, the Kata 2, and then the collapsing dragon. So if this thing fails and fails through that line, this is where you get that collapsing dragon, right? Remember, all of it starts off with a harsh winter. Another way to look at that is this flashcard also. We call the site picture, that we've had a harsh winter. The harsher, the better, as measured by, the RL10 is diminishing and the MACD goes into harsh winter. And so both the RL10 and the baby dragon are dropping. The first alert is when the RL10 rolls over and starts moving up. We know that's going to be where that PSAR flips to, and that's eventually going to be where that collapsing dragon entry is, right? If this price keeps improving, the MACD 4 seasons will go to spring. It'll get through the dragon. This entry is either going to be when the RL10 crosses the dragon, or if price itself takes out the PSAR. So sometimes price will run up so fast that you want to be into it and the RL10 is lagging. So if price goes through that PSAR, if all these other things have happened and price goes through the PSAR dot, then you want to just get long, and you want, as your standard risk box, the belly of the RL10. And so if that's your risk box, it's not unusual to see that you get 2 or even 3 execution risks on the way up. The first big decision you got to make is, when can I get to no lose plus dinner for 2? And then after you've gotten your risk out of it, it's now a science project. You're not going to lose money on that trade. Somewhere after you get about 2, I would say, 2 execution Rs in hand, and it's still working. And especially if you can see, if in your trading at 3 execution Rs is sort of an average win, or you can see some resistance overhead, somewhere around in here, then somewhere after 2, you want to activate your sniper, so that if this comes up and then starts to roll over, you can activate the sniper and get the most of that. If it gets through 3R, then I just sort of automatically am thinking, hey, half my position's on the sniper, half is on the manager. Where am I going to put my second position in? And then I'm studying these upper price targets, observable, reasonable targets, like an RL270 or a VWAP, or if I'm trading intraday, it might be a range stat price level or some reasonable resistance level. So that template is how you get that done. Now, coming back to this one, what I want to say is this SFC or a Kata 2, what happens is it's the same thing. You get that, whoops, sorry about that. You get that harsh winter, crosses over the baby dragon, through the dragon. Somewhere in here, you get your entry. Those of you who have taken the other courses know that later on there's an owl entry. If you wait for the dragon to roll up and the RL30 to roll up, that's where you're getting an owl. If you go back to where the previous peak was and it takes out that previous peak, then any entry above that we would call an emerging dragon. And then you're riding that thing until it rolls over, and now you're thinking about, where are my exits? It might be a 1, 2, 3 exit. It might be on the near side of the dragon, far side of the dragon, or the PSAR. What we're looking for in this, sometimes it's a supported fall crossing, or it's a kata 2, where you have a low and then a higher low. When we have these pullbacks that caused us to get out, and then it does a quick rehearsal, the briefer this fall, the better. I'd like to see if it comes through the dragon and then quickly gets back across the dragon. That's the RLXD, which is the kata 2 entry. Okay. And I love that one too. Because what you had was, in spite of the harsh winter, there was enough buying pressure to establish a local minimum and put together one good trade already. And then the guys came in and started buying it again. So now you're getting ready for leg 2. And that's what makes kata 2 a continuation pattern, a buy on a temporary dip. And now we're looking to see that the size of leg 1 could be the size of leg 2. And that makes this a really low risk, high reward entry. Knowing all the time that my number 1 favorite pattern is the collapsing dragon. So in this price action, if it ever fails to go up further, and anywhere in here is failing and comes through the collapsing dragon, the original bend in the dragon or the RL10, if that price level ever breaches, man, you're on that to the downside for our favorite pattern, our number 1 pattern. Okay. Now, like I said, the audio and video from last night's Q&A session got disconnected. The first couple hours of the audio is pretty good because I was kind of just lecturing, but the last half hour was a detailed discussion and a picture drawing of these 3 patterns. So I wanted to re-record that with some visuals, and then also add this flashcard that talks about what those patterns are. Again, so if I put those 2 together, at the risk of, being really redundant, when I'm looking at the supported spring crossing, I'm looking for number 1, harsh winter. Then the RL10 reversal, crossing the baby dragon. I'm just reading right off the list. The RLXD, winter, somewhere in here, the winter will turn to spring. Sometimes you'll get it. The sequence on these is not as important as the fact that it's all happening, right? You'll get price crossing the PSAR sometimes. And basically the way I want you to think about that is, if this is a slow and orderly move, as this thing is coming down the lip, as it's coming down the stack, you just are drawing these entry levels like a trailing entry stop. And then wherever this thing decides to turn, sometimes this will rocket through here so fast that it leaves the RL10 behind. And so when the RL10 crosses and you want to enter, you look up and you say, oh man, price is already way up here. I could have entered when it crossed the PSAR, and that's what I want you to do. But under more normal conditions, when this price rolls over, it's slowly grinding its way up through here. And then there's enough time for the RL10 to cross and then you get an orderly entry. So that's what I mean by, you would prefer to enter when the RL10 crosses the dragon. You could expect to see somewhere in there that winter turns the spring. But if it's moving really fast and price crosses the PSAR, just go ahead and enter. So basically when either the price crosses the PSAR or the RL10 crosses the dragon, you can enter. And then your initial stop is either the belly of the RL10, and that's what I want you to do until you have 1,000 trades under your belt. Or because of the way the chart looks, you can see it's the dragon is the belly of the dragon is manageable, or you could have a minimum manageable risk box that's even closer. But the default position is the belly of the RL10, because that's the one that has the most, gives you the most wiggle room, and it'll still give you a reasonable reward to risk. So if this is my number 2 favorite pattern, number 1 is the collapsing dragon, as I said. And what we're looking for on that is the RL10 or the dragon made a high and is now reversed. So we got this thing up here. Then it comes down and makes a low. The RL10 or the dragon make a low, and they're reversing and going back up. But then instead of following through and taking out the previous high, instead of coming up here and taking out the previous high, instead it starts to fail. And then it comes down through this belly of the RL10, and then that's your collapsing dragon. And again, your initial stop could be swing high of the RL10. It could have been the previous PSAR, or if the RL10 rolled over here, it could have been this, or the peak of the dragon, or could it be just your minimum manageable risk box? So that's the number 1 preferred. And then the kata 2 is nothing more than this thing moves up, pulls down, crosses the dragon, and crosses up to the upside again, and bang, you're just on it once more, just like I showed in the this one. It moves up, pulls back, crosses the dragon quickly again, and then you're on it for a kata 2. All right. So offer that to you guys as a couple more flashcards to visualize these different patterns. Okay. All right. That's everything I got for tonight. I'm going to get the video from last night for the foundations guys, plus this last little audio chunk, and publish that for their FAQ. So, all right. That's everything I got for you guys. Take good care, and we'll be ready for tomorrow.